Cool. Well, it's going to be mostly be Joe's section here on mortgage rates. Are they going to go up or down? So the media thinks they're going to go up even more and that we're all going to die. I don't think that's true. So this chart will show you the average mortgage rate by decade. And you can see in the 2010 to 2019 time period, the average mortgage rate was about 4.1%. And Joe, what's our mortgage rate now? About 5.5, 5.7?
Yep, 5.5 to 5.7, depending on the day, depending on your down payment, et cetera.
So it's true. Our average mortgage rate right now is a little higher than it was in the 2010s, but it is less than the average mortgage rate of the 40-year period of 1970 to 2009. And we sold approximately 100 million homes, literally, in that 40-year period. So as realtors, we're very equipped to sell homes at interest rates above 6%. This is not new information, so you should not be alarmed. This is the end of your career. You know, the vast majority of the last 50 years, mortgage rates have been a lot higher than this. I think rates are going to go down for two reasons, and I'm going to go through those with you. The first is the last 6 times we've had a recession in the last 50 years, mortgage rates fell every single time. So you can see in the high interest rate environments of the 1980s, the drop was between 4 and 5%. More recently, those drops have been like in the 1 to 2% range. Joe, what do you see when you look at this chart?
Yeah, so I really like this. So let's say today's average interest rate is 5.7%. And you're speaking to a buyer and they say, you know, I really want to buy a house, but maybe I want to wait, and maybe I want to wait for rates to come down. And maybe they've seen information like this or they've learned about it. And you kind of talk them through this and you say, well, when rates get better, you know, the average in a recession that rates decrease is 2.4%. So you're at 5.7 today. Maybe in the future, 5.7 minus 2.4, rates are going to be back to 3.3%. Maybe it does make sense to wait, but that can be a little misleading. Look at the left-hand side of this chart in 1980 and 1982. All right, rates went from 16 down to 12. Rates went from 18 down to 13%. So those two big drops make up a big percentage of that average decrease. If you go further to the right, rates got better in 1991 by 2%, by 0.6% in 2002, by 1% in 2009, and by 1% in 2020. If you average just those 4 most recent recessions, the average decrease in interest rates is only 0.9%. So let's take that same example. We're today at 5.7 minus 0.9. Maybe a year from now, rates are going to be at 4.8%. And so maybe your buyer says, well, I still want to wait because that's going to save me money. Okay, I get that. But let's think through the other half of the equation as housing prices. So we looked previously, you know, kind of the general consensus is prices are going to go up 6%, 8%. Who knows exactly? Today's home is at $600,000 and you're going to buy it with a rate of 5.7%. Well, if you wait for a year to make the math easy, let's say it goes up 10%, and now this home is $660,000. Rates have gone from 5.7 to 4.8, but with this higher purchase price, you may end up with a higher monthly payment. So it's important to just educate clients that waiting maybe is the right thing to do depending on your personal situation, but maybe it's not the right thing to do depending on if you can afford that higher price, or does it make sense to buy the property today at today's rate and then you take advantage of that appreciation? Because the property is likely to go up whether you own it or whether somebody else owns it. Why, Mr. or Mrs. Client, would you not want to be the one owning it?
Yeah, that's really a great argument.
A question here. It says, I'm unable to see the slide. It's blocked by somebody's stuff on their computer, showing small snapshots of email folders. Can I get anybody else? I see your screen pretty clearly. I think everybody can see it clearly. I did see a little pop-up, but I think everything is all right now. All right, go ahead, keep going.
About that, if one of our guys is having a technical problem there, if you go to the handouts column on your dashboard on the right side of your screen, you can download the entire presentation there. So if you're having any trouble, you can get it there. And we're on slide 23, and we're about to go to slide 24.
Yep, and whatever, we just got a comment that did get fixed, so we're good. Keep going.
Okay, cool. This just shows you the economists at Freddie Mac, Fannie Mae, Mortgage Banker Association, National Association of Realtors, what they think the mortgage rates are going to be over the next year. And they're all forecasting that rates are going to drop. I think that's probably correct. Why is that? So not only the recession will bring down the rates, there's something about the spread that will also take place. So if you're not familiar with it, there is the 10-year Treasury yield, and that's the government borrowing money for a 10-year period. And the mortgage rates have a high degree of correlation to the 10-year Treasury. And the spread between the Treasury and the mortgage rate is called the spread, or the gross profit for the banks that are creating all these mortgages for us. And that's just their top line revenues. All of their costs of creating the mortgage, paying for the loan officers, all the underwriting team, all those costs have to come out of that. So if you take a look at the top chart, the dashed red line is the 30-year fixed rate, and the solid purple line is the 10-year rate. And the bottom chart shows you the spread between those. And you can see that the spread historically over the last 50 years is about 1.7%. Currently, it's a lot higher. It's 2.5. It's the second highest it's ever been. So historically, we would expect that that spread would go down over time. And as it does, the mortgage rates will also go down. My hypothesis as a non-lender, I'm a realtor, and Joe will help me out here, I hope, is that there's a lot of volatility in the market. And that when you lock a rate with your buyer at 5.5, and it takes you 60 days to close, if you close and at that moment in time the rate's now 6, the bank has to eat the difference. So they've got to hedge with some financial instruments to protect themselves from that rate shift. And that's an expensive thing to do. And all the uncertainty in the market's creating a lot more expense for that right now. Joe, is that why the spread is so high right now? Will that eventually go down?
Absolutely. Yeah, there's a ton of volatility in interest rates right now. And I think a lot of people see this, and you'll see that one day interest rates are 5.5, the next day they're 5.75, the next day they're 5.6, the next day they're 5.8. And that's not, that happens sometimes, but not over a long period of time, which we've seen now for 120, 150 days, that we've seen these pretty big swings. And so two things. Number one, like you mentioned, it's difficult for mortgage lenders to price loans appropriately when things are swinging so wildly. That's number one. And number two, if you notice on the bottom chart, how that spread increases during every recession. So mortgage lenders and banks are run by really smart people, and they're pricing in some of the risk of potential future defaults, right? Going into recession, I think we all agree from our prior slides, there's not going to be a foreclosure boom, but there are going to be some defaults. There's always someone, even in good times, there's always somebody that falls behind in their payments, can't pay their bills, etc. I think part of this spread is mortgage lenders and banks making a little bit of extra profit right now to price in what is the risk that we're going to lose some money in the future due to some unforeseen defaults that we haven't seen yet. So I think both of those things are contributing factors.
Big parts. So when you take a look at this earlier slide, let me get this out of the way here. I apologize, I brought up a list of questions while Joe was talking. Now I can't get the folder to go away. When you look at the economists predicting that the rates for mortgages will go down, I think what Joe just talked about is the explanation of why. Thank you for that. So
Yeah.
I want to talk about affordability. So there's a lot of negative headlines about how homes are becoming a lot less affordable. And if you were just to look at the last like 10 years, those headlines are absolutely correct. But I want to take a big step back and say, over a 30-year horizon, how affordable are these homes right now? And the answer is, we're exactly at the 30-year average for affordability. So this comes from the National Association of Realtors, and what they're doing here each year is they're taking the average home price, the average mortgage rate, they're assuming 20% down, they're taking the average mortgage interest rate that year, calculating the payment that'd be required, and then they're saying, how tough would it be for the average income person to make that average mortgage payment? And you can see that we're exactly at the historical average for affordability. The reason why it feels so negative to us right now is that in 2012, we had our very best year of all time from an affordability standpoint. Why is that? You'll remember that we had a huge crash. The average home price dropped about 25% in 2007 and 8. And by 2012, prices had come up a little bit, but not a lot. So they were still very depressed. But the mortgage rates were really cheap, trying to stimulate the economy out of that recession. And incomes, generally speaking, were pretty strong. So with relatively high incomes, cheap purchase prices and cheap mortgages, the affordability hit an all-time high in 2012. And in the 10 years since then, it's gotten worse every single year, which is what a healing economy should look like, right? The mortgage rates didn't have to be supported, so the mortgage rates have gone up. Home prices have gone up. Incomes have also gone up, just not as fast. So as a result, if you compare today's affordability to the best year ever in 2012, it's a lot less affordable. But if you look at the long-term average, things are quite affordable, so there's really nothing to worry about. Jody, anything on this one?
Yeah, I do. One of my comments that I hear from a lot of folks is, oh man, houses are so expensive. Affordability is going to price a bunch of people out of the market. And I think that's true on an individual basis, right? You're going to see some people that can no longer afford to live in the areas that they want to live in. But this chart shows us as an overwhelming large percentage of the population, people can still afford homes. And another part of it is a perception problem. And what I mean by that is look back at this chart from 2010, 11, 12 till now, homes have usually been, over this 10-year period, have been very affordable. Well, if you zoom out and look at this entire chart, those last 10 years were the weird times, right? So everybody right now feels like, man, the market is crashing. I can't believe what's going on with interest rates. I can't believe what's going on with home prices. Well, we kind of have a tendency as people to have this short-term memory, and we feel like the last 5 years has been normal. And the last 10 years has been normal. But the last 5 and 10 years have actually been abnormal. And we're going into what is going to be kind of normal, or what has been normal for a long period of time. Now, it's a little bit painful, right? We all enjoyed cheap interest rates, housing appreciation, et cetera. But we're going from the weird times to the normal times. And it's important for all of us to be able to convey that to our clients that, hey, we're not going downhill, we're going to normal, which will actually make it a little bit easier for buyers on future transactions, which I think we'll talk about later.
Absolutely. Thank you for that.